Hi, Matthias. We're here again for a chat about valuation. And this time we're going to be talking about valuing young companies. How are you doing today?
Very good. Hi, Ken. I hope you're doing well.
Excellent. So, the valuation of young companies, what is, again, unique enough about the challenges they present to a valuer to warrant a separate chapter?
Yeah, as a valuer, what we like or what makes our work easy is if we have a stable environment, a mature company which doesn't change too much in the future, a publicly listed companies where we have available data. And all of this we do not have when we look at young companies. The environment is often very dynamic. We talk about markets which do not exist today, but perhaps tomorrow or hopefully tomorrow. We do not have a past where we can learn more about this company. And young companies, of course, are rarely publicly listed. And this all makes the valuation and the analysis of such companies quite a challenge.
Interesting. So let's go through a couple of the standard methodologies and just think about why they may not be appropriate for valuing young companies. Let's start with multiple based valuation. So relative valuation, looking at similar companies and using their data about their earnings, their book value, whatever it might be, to value a young company. Why might that not be a reasonable thing to do?
So, starting with the trading multiples, so multiples based on publicly listed companies, the dynamics are totally different between these two companies, and the information we can take from the multiples of publicly listed companies, that they cannot be used for the valuation of young companies. So the multiples do not speak the same language. We might look at transaction multiples, so multiples we can derive from mergers and acquisitions transactions. But this also very often relates to companies in a different state. So very rarely we really find the comparability between the company on which we base the multiple and the company we want to value. And this is quite a challenge. Although I will not say that we do not use multiples at all, but the application is quite a challenge.
Okay, interesting. Now, what about if we're looking at DCF, discounted cash flow? What about using that for valuation?
A discounted cash flow method, as we have also written in different parts of the book, is always, in theory, the best method to value companies. But in practice, the challenge is to fill this discounted cash flow model with life, to make a sound forecast of future cash flows. And now, when I said the visibility for young companies is very low, we do not have a past. It's really a lot of uncertainty in terms of forecasting future cash flows. And this makes the discounted cash flow method, DCF method, a valid method, but it's really tricky to apply it in practice because the forecasting of cash flows is so tricky. And not only the forecasting of cash flows, I have to say, also because of the elevated risk profile of young companies, the determination of discount rates is also quite a challenge.
Yeah. And I guess with young companies, often they're not making any money and not generating positive cash flows. So this means you're dealing with a lot of, let's be honest, negative numbers.
Absolutely. The way to revenues is very long for young companies. This is a challenge for our valuation models, but it's a particular challenge for analysis. So it's really tricky in some cases to understand whether this is a bad company, which is loss making, or whether it's still in the process of investing and perhaps turning into a path of positive revenue somewhere in the future.
Yeah. Now, I noticed in the chapter that you wrote in the book, Matthias, you refer to the venture capital method. Could you just explain that?
Yeah, the venture capital method takes the best of two worlds. So the best of multiples and the best of discounted cash flow for this particular situation of valuing young companies. The venture capital method is called venture capital method because it's based on the idea of a venture capital fund who holds an investment in a young company for a couple of years, let's say 5 or 6 years, and then exits the investment. So the idea is to make a forecast of cash flows for a reasonable time period, the 4 or 5 years, where you at least can roughly make a forecast, and then to assume at a particular point in time the exit from the investment. And the exit then takes place when the company is hopefully in the future in a more mature state. And then we can apply multiples for the exit from this young company at this future state. So we pretend that in the future the company is more mature, and then it's more comparable to the companies from which we derive the multiples. So we take the best of two worlds, making a little bit of a forecast, and then using multiples for valuing the company.
And presumably then we discount that value back to today to try and get a valuation.
Absolutely. We discount it back. We take interim, so the negative cash flows, which might be the case for the first years. We take them into account. We take into account that a venture capital investor might get diluted because of more financing rounds. Dilution means that the amount of investment, the relative amount of investment reduces because fresh equity is invested in the company. So we take everything into account for the first 5 years, but then after 5 years, we assume it's a mature company, we can value it. And yeah, that's the venture capital method.
Fantastic. Very helpful, Matthias, as ever. Thank you.
Thank you.